I'm about to share something I'm not supposed to tell you. After 15 years in the financial industry, managing investments for elite clients with over 10 millions in portfolios, I've uncovered their secrets. It's a simple trick that's building massive wealth for the ultra rich. And it doesn't involve working harder. Imagine waking up to see your bank balance grow while you're asleep, picturing yourself living in your dream home, taking time for your family when you decide to, and never worrying about money again. This is the fantasy. This is the reality for many people I've helped. It's powerful yet so simple. The wealthy elite don't want this information getting out because they fear everyone will start doing this. But I believe everyone who truly wants it deserves financial freedom. So, why is this strategy so powerful? It's all about harnessing the eighth wonder of the world, as Einstein called it, compound interest. And the rich have been quietly using this force to grow their wealth exponentially. And now you can too. But here is the kicker: the investment industry does not want you to know about this secret. Why? Because it's a simple strategy you can use yourself, cutting out the middleman. They would rather keep you in the dark, pushing complex products that make them money instead of you. So, in the next few minutes, I will reveal the powerful yet surprisingly simple strategy that could change your life forever. The strategy that the industry is keeping secret. So, we are discussing a simplified investment strategy using a 3 ETF portfolio that could yield impressive returns with minimal complexity. Perfect for those aiming for long-term financial freedom. This approach leverages the power of compound interest across different market segments, allowing your money to work harder for you over time. So let's break down these three pillars that form the foundation of this wealth building secret. The first one is foundational ETFs, your broad market base. Number two is dividend ETFs, your steady income generator. And number three is the growth ETFs, your wealth accelerator. Each of these components plays a crucial role in maximizing your returns while managing risk. And together, they create a powerful engine for long term wealth. Creation that the ultra wealthy have been using for years. Now, let's dive into each pillar and see how they work together to potentially transform your financial future. Number one, foundational ETFs. These are the building blocks of your portfolio. They can provide broad market exposure and form the core of your investments. So let's take a look at three options. Number A, the Vanguard S&P 500 ETF, the FU, focuses on the 500 largest US companies with an impressive 12.84% annual return over the past decade, with a proven track record of weathering market volatility. Then number B, the Vanguard Total Stock Market ETF, the VTI, diversified across 3,700 companies, delivered a 12.18% annual return over 10 years, offers a broader market exposure. Then number C, the Swap US Broad Market ETF, the SCHB, similar to the VTI, providing with US market coverage. A solid 12.24% annual return over 10 years. So all these three ETFs offer broad market exposure but with slight differences. The FU focuses on large cap stocks while the VTI and the SCHB provide exposure to a wider range of company sizes. VTI is slightly more diversified than the SCHB, but both offer comprehensive market coverage. So your choice might depend on whether you prefer to focus on large companies like the VOO or on the broadest possible exposure like the VTI or the SCHB. Then number two, dividend ETFs. Next we have your reliable income generators. These ETFs focus on companies that consistently pay dividends, providing a steady income stream over time. Here are two top choices. Number A, the Swap US Dividend Equity ETF, the SCHD. It tracks the Dow Jones US Dividend 100 Index with a 10.81% annual return over a decade. Focuses on strong companies with reliable dividends. Then we have B, Vanguard Dividend Appreciation ETF, the VIG. With an 11.09% annual return over 10 years, follows the S&P US Dividend Growers Index. It invests in 340 dividend growing stocks. Both of these ETFs aim for dividend income but with different approaches. The SCHD focuses on companies currently paying high dividends, while the FIG targets companies with a history of increasing their dividends over time. So the SHD might be better for immediate income, while the FIG, the VIG, will be preferable for long-term dividend growth. Then number 3, growth ETFs. Finally, we have your portfolio's turbo boosters. These ETFs aim for dividend growth potential, focusing on companies expected to grow faster than the market average. So here are 3 options. Number A, the Vanguard growth ETFs, the VUG. Then number B, the Swap US large cap growth ETF, the SCHG. Then number C, the Invesco Nasdaq 100 ETF, the QQQ. These ETFs focus on high growth sectors, particularly tech giants like Nvidia, Meta, and Amazon. They offer higher potential returns, but remember, with higher rewards comes higher risk. VUG and SCHD cast a wider net in the growth stock universe, while QQQ specifically targets the largest non-financial companies listed on the Nasdaq, which tends to be tech heavier. So by combining these 3 types of ETFs, you are creating a diversified portfolio that balances broad market exposure, steady income, and growth potential. The exact mix would depend on your personal financial goals and risk tolerance. Now, here's the $1,000,000 question. Is this the right time to invest? Many worry about buying at markets high. That's why it's crucial to watch our upcoming video. Should you buy index funds now in an overvalued market? Remember, the most critical factor in investing isn't just picking the right ETFs, it's your mindset. Staying invested consistently, regardless of market fluctuations, is key.